Hi, my name is Mak Kar Wing, Matric number 305483. I will be presenting my individual report on the determinants of Shanghai Fosun Pharmaceutical's performance. This study aims to identify the key determinants from both internal and external factors that have a significant impact on the firm's financial performance, measured through return on equity (ROE). Shanghai Fosun Pharmaceutical, founded in 1994, is one of the largest pharmaceutical companies in China, operating across the entire healthcare value chain, including manufacturing, medical device, and healthcare service. The company has a strong research development focus with an extensive global presence, and a key milestone was its collaboration with BioNTech on mRNA COVID-19 vaccines. It is also recognized for its public health contribution through the production of artesunate as a major anti-malaria drug. Despite its strong market position, Fosun Pharma has experienced a significant decline in performance. Return on equity fell from 14.48% in 2015 to 5.26% in 2023, with only a marginal recovery in 2024. This reflects weak operational efficiency and shareholders' returns. The situation became worse in the year of 2018, following a whistleblower incident that led to an FDA warning and a sharp drop in share price, highlighting governance weaknesses. In addition, aggressive expansion has increased financial and liquidity risks, raising concerns over the firm's long-term sustainability. This study aims to examine the key determinants of Shanghai Fosun Pharmaceutical's performance. First, to identify the internal firm-specific factors that influence the company's performance. Second, to identify the external or microeconomic factors. Finally, the study investigates the combined effect of both internal and external factors on overall performance. Accordingly, the research addressed three main questions: whether internal factors, external factors, and their interaction have a significant relationship with Shanghai Fosun Pharmaceutical's performance. For literature review, this study focused on credit risk and liquidity risk as the key risk factors affecting firms' performance. According to Stiglitz and Weiss, credit risk comes from information asymmetry, which can lead to adverse selection and moral hazard. At the firm level, lower profitability shown by ROE and ROA reduce a company's ability to repay its debt. From an external view, slower economic growth and higher interest rates raise borrowing costs and increase the credit risk. Liquidity risk is explained by Diamond and Diewick, who state that liquidity risk is not only about holding cash, but the ability to turn assets into cash quickly and at low cost. Internally, liquidity ratio and the average collection period show how well a firm can meet short-term obligations. Externally, higher interest rates and inflation make funding more difficult and reduce available cash. This study focused on Shanghai Fosun Pharmaceutical with a sample period from 2015 to 2024. The data used are secondary data obtained from the company's annual report, covering 10 years of financial and microeconomic observations. Return on equity (ROE) is used as the dependent variable to measure firm performance. For the analysis, multiple linear regressions using the ordinary least squares method is applied. All statistical analyses are conducted using IBM SPSS Statistic version 29. The study includes descriptive statistic, correlation analysis, model summary, ANOVA, and coefficient analysis. Three regressions models are developed. Model 1 examines the impact of internal firm-specific factors on ROE. Model 2 focuses on external microeconomics factor, while Model 3 combines both internal and external factors to assess their joint effect on ROE. This slide presents the descriptive statistic for return on equity. The mean ROE is 10.03%, which indicates relatively consistent returns to shareholders over the 10 years period. The standard deviation is 3.17%, suggesting a moderate level of volatility. Overall, the results show that Fosun Pharma's equity returns are stable but still subject to normal performance fluctuations. This slide highlights the most significant correlation with ROE. ROE shows a very strong positive relationship with ROA and operating margin, indicating that asset efficiency and operating profitability are the key drivers of shareholders' return. In contrast, urban population has a strong and significant negative correlation with ROE, suggesting external demographic pressures may reduce profitability. Meanwhile, variables such as the current ratio are not statistically significant, indicating that liquidity and similar indicators have limited direct influence on ROE. This slide presents the model summary for the regression analysis. The internal factors model has the highest explanatory power with an R-square of 0.995, indicating that firm-specific variables strongly explain variations in ROE. The external factors model show a lower R-square of 0.809, suggesting that microeconomic variables have a smaller impact on performance. Finally, the combined model, which includes both internal and external factors, has an R-square of 0.972, showing that while internal factors remain dominant, external factors also contribute to explaining ROE. Overall, these results confirm that operational efficiency and firm levels characteristics are the main drivers of Fosun Pharma's financial performance. The ANOVA result indicate that the internal regression model is highly significant with a p-value less than 0.001, showing that internal variables collectively have a strong and statistically significant effect on ROE. For the external variables model, the p-value is 0.056, which is significant at the 10% level but not at 5%. This suggests that external factors have a weaker yet meaningful joint effect on ROE. Finally, the combined model of internal and external variables has a p-value of 0.094, also significant at the 10% level. It confirms that while the joint effect exists, internal factors remain the dominant drivers of Fosun Pharma's financial performance. The regression results show that among internal factors, operating margin and average collection period are highly significant, with p-value below 0.05, indicating they are the main drivers of ROE and corporate profitability. Quick ratio and debt to income are only marginally significant, while the operational ratio is not significant, suggesting limited impact. For external factors, inflation and tariff are significant predictors of ROE, meaning changes in this macroeconomic variable can affect company profitability. GDP growth, interest rate, and political stability are not significant, showing minimal effect. Overall, internal efficiency, especially profitability and receivable management, strongly affect ROE, but among external factors, inflation plays a more dominant role than most internal indicators when combined. This highlights that both operational management and key microeconomic pressures influence Fosun Pharma's financial performance. In conclusion, internal factors are the main drivers of Fosun Pharma's performance, with operational efficiency being the key. ROA and operating margin show the strongest correlation with ROE. When external factors are included, inflation becomes the most significant variables, highlighting the impact of macroeconomic cost conditions. Based on this, Fosun Pharma should focus on improving operational efficiency through cost control and better asset utilization, strengthen compliance and risk management with strong audit, strong monitoring, and adopt a board-level operational risk framework to enhance oversight and support sustainable ROE growth. That's all for me. Thank you.